Oh, hey everyone, thanks for coming back for your morning quickie. I've got a stamina potion and 3 quick things to address. And honestly, they're pretty damn bullish. Let's talk about it, because they bring us back to the Lehman Brothers day, which sounds not very bullish. But if you stay to the end, you'll understand some insight that you might miss in case you didn't stay to the end. Like yesterday, I got a comment from somebody's like, hey, you made videos a few months ago with so much doom and gloom that I sold. And I'm like, did you miss the part in almost every single one of those videos where I'm like, but this is the time to buy? Because if you zoom out and you're in a recession, you're like, oh damn, if I could ever time when to buy in my life, I would buy stocks in a recession. Not my problem. I say it in every video. If you click out early, your problem, not my problem. Anyway, take a look at this. Number 1. Few winners in the stock market. This is a chart showing the percentage of members at new 52-week highs. And as you can see, usually we sit somewhere between that 10 to 20% level, the white bars being that S&P 500 level. Did get a crazy spike there in 2021, but these new 52-week highs, very, very interesting. The reason you got that spike in 2021 is because it really lapped over from like March and April of 2020. But if I remove myself, look at this corner here. Woo, very, very, very low 52-week highs. I like that. I actually find that pretty bullish. And so does the stock market, which is actually rising quite nicely this morning so far, leading into a market open. Now, why would that be? Well, because we are going back to the Lehman Brothers days, which again, sounds very negative, but if you actually listen to the details, it's because we got the PPI report this morning, which could have literally undone the great news of CPI yesterday, but no, it didn't. If anything, it reiterated the great news of the consumer price index inflation drop, with now the producer price inflation drop coming in at a substantial low, going all the way back to Lehman Brothers days. In fact, it came in so great that look at this particular chart here. We once again miss expectations like crazy. The survey called for month-over-month PPI an increase of PPI inflation of 0.2%, which would be 2.4% at an annualized rate, right? It actually came in at an annualized rate of a negative 6%, which is a month-over-month rate of a negative 0.5%. Great, excellent miss. You also, if you exclude food and energy, had a miss, again, coming in below survey. If you exclude food, energy, and trade, also miss. Year over year final PPI demand also comes in at a miss. This is great. This is actually really freaking good news. Now we're starting to reiterate the decline. Now, I know most of us aren't that interested in all the details that go into producer prices like commodities and that. We got some other stuff to talk about anyway. But take a look at just the bottom line here, okay? 80% of the decline in goods prices, stuff we buy, right, that producers make, was due to a 16.7% plunge in gas prices. That's great. So a lot of that decline came from gas prices, but then that leaves the question of, okay, but is inflation just moving over to the services sector, which was always a big fear? Well, service prices rose just 0.1% in July, which is an annualized rate of just 1.2%, well below the 2% Federal Reserve target. So look, believe the PPI or CPI numbers or not, but this is actually very, very good. And I like to provide us good news when we have it. And it makes for shorter videos. It's great. Now, a couple other quick notes. First, I saw this and it was kind of hilarious when the PPI numbers came out. If you're wondering why people confuse year-over-year changes with month-over-month changes, it's because they're stupid. No, I actually don't agree with this. I think, honestly, that it is kind of confusing because it's something that we don't learn about in school. So I want to give you a very quick mini lesson on what the hell these month-over-month and year-over-year changes mean in an easy way for you to understand. All right? And I actually gave this analogy to course members the other day, and I think it really helped, so I just want to provide this to everyone. Let's say that on January 1st, you weigh 100 pounds, and the reason I'm using losing weight is because in January I was definitely a little heavier than I am now, and I had trouble getting down the ski slopes, and now I'm like down 24 pounds, and I'm like, let's go. But anyway, let's stick with this analogy. Let's say January 1st you weigh 100 pounds, and then let's say April 1st of that same year you weigh 120 pounds. Okay, now I'm going to show you quarter over quarter, but it's basically the same thing. Now you've gained 20 pounds in 1 quarter. That is almost like being on this speed of, if you're gaining 20 pounds in a quarter over quarter, that's basically being on this trajectory. If you stay on that weight gain trajectory, by the end of the year, you could be at 80 pounds of weight gain, which is a lot, right? That's because the speed you're going at is represented by a quarter over quarter figure, which you multiply by 4. This could also be a month over month figure, right? If this was February 1st, then what we would actually do is say you just gained 20 pounds in 1 month. You multiply that by 12, you're on pace to, in that case, in 1 month, 20 pounds, gain 240 pounds in a year if you stay on that speed, right? That's the speed you're looking at. Now, if we then say, okay, well, you gained 20 pounds from January 1st to March 31st, and then the next year, that very next January, so January 1st plus 1, kind of like an airline, right? Plus 1, because it's the next day. No, anyway, the next year, you weighed 120. Well, now, year over year, you gained 20 pounds, so that means you had a 20% year over year move. So you gained a lot of weight in that first quarter, and then you stopped. And visually, why that's very, very important is because it means you had this really high speed of gaining weight at a rapid rate, and then you stayed flat. And when you make that year over year comparison, you're still up 20%, but on a month over month basis, you're stable. And that stability is important. That's what we're looking for. So when we see PPI numbers come in at negative 0.5%, it's really good news. If you see CPI numbers come in at 0% month over month, it's really good because it implies that stability or an inflection point to the downside in the case of PPI. Okay, last thing, in this morning's course member live stream, we're going to be going deep into Matterport's fundamental analysis on their earnings. We're really excited about that, but I do want to say we do still have risk factors going to the upside on inflation because companies are doing so decently with earnings. Look at what happened with Disney last night, but they're still raising prices. So it's still a red flag. Folks, check out the courses, link down below. People who invest in the Series A and who are course members are going to get a special bonus options for the future. At least that's what we're currently planning. And you will enjoy the lifetime access and the continued addition of content. There's so many wonderful comments from you who are both course members and active watchers here who love the content. Keeping the pitch to the end today. Hope you appreciate it, and hope you appreciate the shorter vid with no sponsor. Thanks, folks. We'll see you. Bye.